Okay, good morning, good afternoon, good evening. It depends on when and where you are watching this video from. Once again, I welcome you to this wonderful topic. Very, very important. Okay, a lot of people try to ignore this, especially the new traders, and they will later find out that they've lost or they've ignored greater part of trading. What am I talking about? I'm talking about trading psychology, risk, and then trade management. In fact, before you even dive into technical analysis and then or start trading on forex or any financial market, it's very, very crucial, it's very, very important to understand trading psychology and then risk management before you dive into it or before you invest your real money, because without trading psychology you are going to lose even with the best technical analysis, or even if you are the best technical analyst and your trading psychology, your risk and then trade management is poor, you are still going to lose. And if someone who is an average market analyst and has a good trading psychology with risk and then trade management, the person is going to do extremely well. Okay, he's going to perform wonderfully. So that's why I have typed everything, and also I'm going to go through with you, and I think at the end of this lesson you are going to take one or two important things from this video. Okay, so now the first thing we are going to do is we are going to define trading psychology. Now, what is trading psychology? Let oh okay, so let me highlight the definition, and then it simply means the state of mind a trader should have while trading. Trading psychology is one important aspect of every professional trader, as it involves dealing with the trader's emotions in the market to control fear and greed. Many newbies traders tend to ignore the topic. They then realize in later state of countless losses that trading is a mental game. Trading is 10% strategy and then 90% psychology. Sorry, instead of psychology. So let me just, for the sake of time, let me use the short form for psychology. Okay, so it's 10% strategy and then 90% psychology. So let's try to understand the definition. You see, trading is money, and everything that deals with money is in contact with your emotions, because money physically, money can do a lot of things, almost everything. When you go to the spiritual side, that is when money is less. Okay, but in physically, money can do a lot of things. Money can do a lot of things. So with this issue that we have with money is attached to our emotions. Okay, and if anything you are doing is money, simply your emotions is attached. Now, one thing about trading is whenever you are in trade, try to remove emotions. What do I mean? It means that if you are trading and you are making profit, don't be overjoyed. Don't think that you are not going to lose. You have overcome the market. So you are doing things that goes contrary to your trading plan or trading strategy. Okay, so think like a robot. Robot has no feelings. When he's going, he's going. When he's coming. Okay, so think like a robot. When you are winning, think about your strategy. Don't be overjoyed. Stick to your strategy. The same thing when you are losing, don't lose hope. Don't think you are not going to use, you are not going to win. And I can promise you that strategy that I'm teaching is very, very powerful, but it is not above stop loss. No strategy is above stop loss. All the strategies are below stop loss. Okay, so if the strategy is giving you losses, don't think that you are not going to win, or don't think that you are not going to recover the losses, or don't think that that is the end part. No, think like a robot. Think that no matter how painful the trade is, or no matter how painful the losses is, you are still going to recover. Okay, that is why it's very, very important to deal with emotion, or eschew emotion, throw emotion away from this market. Okay, because it's a mental game. it plays with your mind. That is trading. And as I said in the market structure video, forex market or crypto market, any financial market you are trading, it doesn't move in a straight line. Zigzag, it goes up, it comes down, it goes up, it comes down. So if you are trying to follow it with your emotion, my brother, my sister, you are going to get lost. Okay, so just after trading, you are after taking the trade, and then you know that all your confluences are intact, all your trade management, all your rules are intact. Just leave the rest to the market. You cannot control the market. Okay, just leave the rest to the market. The thing you can do is trade management, and we go to trade management. Okay, so that's the definition of trading or trading psychology. Now, these are some of the mistakes the newbies do over trading. They think that they need to trade every market every hour before they can make money. No, it is not true. Over trading will rather lead to losses. Now, what is over trading? As a trader, you are a businessman. So you need to have your profit target. My profit target for this week is this. My profit target for the day is this. Now, if you achieve your target, exit the market. Let the market do what it's doing. You get it? That is why you said take profits. When the market hits your take profit, accept it. Ignore the market. Okay, if the market has not hit your take profit but you've achieved your daily target, let me say you have $100 account and your target is to achieve $5 a day. When you achieve your target, get out from the market and then look up to the next day. That is if you are a day trader. But if you are a swing trader, you hold position for weeks. Your target, you should plan your target weekly. This is my weekly target, this is my monthly target. When your monthly target is hit, get out from the market. When your weekly target is hit, get out from the market. Now the same applies to stop loss. You set stop loss. When your stop loss is hit, let me say you have a plan that you are risking $50 in a day, or you are risking $6 or $3 in a day. When your stop loss target hits, don't trade again. That is your rules. Okay, that is your rules. That is why when you are setting your rules, it should fit your behavior, it should fit your daily schedules, it should fit your weekly and the monthly schedules. Okay, if you're too busy and you cannot be on the screen always, you should be a screen trader. You should be a screen trader. If you're too busy, you cannot be on the screen. You shouldn't be a day trader. You shouldn't be a scalper, because scalpers, they have to be on the screen always, and day traders too. Okay, so if you're a person that will want quick results, and you have time to be on the screen, I suggest you go for a day trading or scalping, because you always want quick result. But if you're a person that you are busy, you cannot be on the screen always, and also, you want long-term results, you can focus on long-term results, do swing trading and go your way. That is it. But the most important is not be over trading. Now, over leveraging. You see, I will talk about it right now, but let me say something more about over leveraging. People think, you know, trading is gambling. No, trading is business. Eh? If you trade trading like gambling, that is when you over leverage. Every account has its respective lot size to be used. You get it? Every account has its respective lot size to be used. Ideally, $1,000 account should be using 0.10 lot size. I have the illustration down here. But we will get back to them. $1,000 account should be using 0.10 lot size. $10,000 account should be using one standard lot size. $100 account should be using 0.01, and $50 you can also be using 0.01. Okay, so do not over leverage. I see $500 account and he is using one standard lot size. One standard lot size is for $10,000 account. With this, you are trading trading like gambling, but you should be treating trading like business. Okay, so let me go here. Lack of emotional control. I've talked about it. When you are winning, don't think you are going to win always. So you'll be over leveraging. No, stick to the plan. When you are losing, don't think you are going to lose. So you taking unnecessary trade. No, wait for the plan. Okay, the best way to recover your losses is to wait for a good setup and trade. That's the best way to recover your losses. Okay, don't think that trading too much will help you recover your losses. No, it is rather going to harm you. That is revenge trading. Trying to revenge the market. You cannot revenge the market. Why? The market is always right. We are the people who either being right or wrong, but the market is always right. So don't try to revenge the market. Okay, don't try to revenge the market. When you lose, wait for proper setup and then take the trade. That is the way you are going to recover your losses. That is the way you are going to recover your losses. So don't be over sorrowed when you are losing, and don't be over enjoyed when you are winning. That is the emotional control. You need to control your emotions. Now, not thinking in probabilities. This market, the analysis we are doing is not a certain analysis, or it's not a constant analysis. What I mean is, it's not something that by crook or hook is going to happen. Your analysis is based on probabilities, but you always go in favor of high probabilities. Okay? Probability that something is going to happen 90% doesn't mean that the 10% doesn't have a chance. Probability that something is going to happen 80% doesn't mean that the 20% doesn't have a chance. Okay, so no matter how perfect, how good your analysis is, you still can lose. So think that your analysis is probability. It's not something that is certain by crook or hook is going to happen. No matter how good you are, your analysis is probability. So you can lose, you can win. You can lose, you can win. Okay, so think that your analysis is probability, and this thing is going to guide you, going to open your mind, make you know that losses are normal. Accept losses because your trading is a probability. Either you lose or win. But we try to learn, we try to practice to always go in for the high probability setups. Okay, so lack of patience. Remember, I said that if you can't wait to trade good setups, you lose money to trade good setups. That is one of my quotes, quote from me, myself. If you can't wait to trade good setups, you will lose the money to trade good setups. Patience. If you don't have patience, you should find different business to do. Forex is not for you. Because sometimes, for instance, a swing trader, you can sit on the screen the whole week and you will not get a good setup. I'm a victim. There was a week I didn't trade. Why? Because I didn't have any good setup to trade. There was a week I traded only once because that was the good setup I had. And there are weeks I have about 5 pairs to trade. That's the market. Okay, so always have patience. Wait for the market to get into your POI, the point of interest. Wait for the market to get into the area you want to buy. Bear this in mind that if you don't wait for a good setup, you are going to lose. That is it. Now, holding on to losses, we set stop loss for reasons. We set stop loss for reasons. Okay, so when trade is about to hit your stop loss, allow the trade to hit a stop loss. Now, plan next trade and recover the losses. You get it? Some people, when the trade is about to hit their stop loss, that's the time they increase the stop loss. You are rather extending the losses. Okay, we are rather extending the losses. So don't hold to losses. When the trade hits stop loss, allow the market to do its things and then move on to the next setup. Trading opportunity is like train. Okay, transport a train that we use for transportations. Train. When one passes, another one is coming. So why chasing the one that is already gone? You get me? So always don't hold on to losses. Allow the trade to hit a stop loss and then wait for next setup. Now closing winning early. Reset, take profit for reasons. Okay? Unless maybe there is a strong fundamentals coming before you close your trade. Okay? But stick to your plan. Wait for TP. Take partials. I'll talk about trade management in a few minutes. Take partials and then wait for your TPs. Don't close your trade early. It will pain you if you close your trade early. Let me say your profit target is 100 pips. And when immediately you get 40 pips or 50 pips, you close the trade 100%. and you come back to see that the market has actually go to 100 pips, it will pain you, because maybe if you waited for hours, if you waited for days for that setup, and you've closed the trade early. No, you have to stick to the plan, wait for TP. If it is partials, you can close half of your position and then hold the remaining ones. Okay? Or you can set break even and hold the remaining ones. That is it. Now, you cannot buy and sell at the same time. Oh, this is what some people think. You see, when you buy and the market is selling, you lose. And you sell and the market is buying, you lose. So this is what they do. They buy and sell at the same time. So in case the market sell, they have something. So to make the market buy, they have something. This is sorry to say, but this is nonsense. Okay, you cannot buy and sell at the same time. You end up blowing your account. Why? Because this battle is against buyers and sellers. Either the buyers wins or the sellers wins. So find the ones with the higher probability, the one with the strongest, then you join them. Okay, so you either buy or sell. Don't buy and sell at the same time. Now let's move to how to mentally be prepared. Now, how to mentally prepare yourself for trading. Make realistic goals. I said it earlier on. Have a goals, have a trading plan, have a book devoted for trading. Okay, trading. Write your weekly plan, write your daily plan. Okay, if you are a swing trader, add monthly plan. Okay, the week is coming on Sunday evening or on Saturday or Friday evening when the market is closed. Which pairs are you going to look? Write them down, jot them down. Okay, how many risks are you going to take? I mean, how much money are you expecting? Write everything down. Don't let them be in your head. Write them down. Monday morning, go through, read it. Okay, and one thing, the market, you may have a some good setup. The market will not give you opportunity. So when the market opens, scroll through or go through your pairs again or your watch list again. Okay, you may find some good to add to your watch list. Write them down. Okay, so make a realistic trading goals. So if you have been following me critically, you can see that you are trading forex as a rare business, and forex is a rare business. Okay, sorry to say, there are a lot of professionals who are not rich financially. I know a lot of professional teachers, professional doctors, professional army men, professional police, professional doctors who are not rich financially. But if you can show me one professional trader, eh, who is not rich, I will delete my TradingView account and my MT4 account. If you show me one professional trader, I'm not talking about the newbies, one professional trader who is not rich, I'll stop trading. Why? Because this business is very, very good business. That is, if you understand it to trade it like a business and you devoted time and effort to it to learn it. Okay, in Africa, we have a whole lot of, I can mention a whole lot of traders. In Ghana, we have Kodo Forex, we have Yaswinga, we have Kira FX, we have Common FX, we have Joe Trader. Five, just in Ghana here, I've mentioned five. Not to talk about Dr. Harmonics, Hunter, a lot of traders. Okay, they are powerful traders. Ghanaians, when you go to Nigeria, we have Happy Forex, we have this guy Jeffrey Benson. All these guys, they are powerful traders, powerful forex traders. When he goes to South Africa, this is my mentor Sakwan. A lot of powerful traders. Okay, they are all rich financially. They are all rich. Okay, so this business is very, very powerful. That if you get time for it and try to treat it as business, it's going to help you. Now prepare for a lifestyle change. Trading will change your lifestyle. You see, the way we think normally is not the way we think on the financial market. Okay, so I've talked about it. Allow the market to do its things. Adjust yourself to the market, and then I will not waste much time here. Treat forex as business or trading as business. That is thing I've talked about. I will not waste much time here. Now let's go here. This part. Ask yourself if you are ready to become a full-time trader. Now, don't quit your job when you are learning forex. If your job will give you time to learn once you are in your work. Okay, why? Because when you quit your job, all of your financial burden becomes forced on the trading. And if you are not a person or a professional trader, it's going to affect you psychologically. Okay, it's going to affect you psychologically. It's going to force you to take unrealistic trades. Okay, it's going to force you to take unrealistic trades. You get it? So do your job as you trade. When it gets to the time and think that no, now your confidence is at the maximum, now you can do a lot of things. Why not quit your job and then do your trading? Trading is very, very nice business. Now let's go to risk management. PIPs, the first thing is PIPs calculation. Second one is PIP value in dollar, amount to risk in a trade, and then lot size. Now with the first one, which is PIPs calculation, we are going to use TradingView risk calculator, and I taught you this in the TradingView video. So let's go to TradingView and then see what we can do over here. So I've taught you this thing, so I'm not going to waste much time here. When you go to your your positions or your measurement tools, you get price range. Okay, you see this one is called price range, which is part of my favorite tools. So we just drag it and you can see the pips. This is the pips I'm talking about. We have 448 pips. This is the pips I'm talking about. So we know how to calculate pips. Okay, know how to calculate pips. And let me say you have a position to your long and short positions can also calculate the pips for you. Can also calculate the pip. I want to show you an example. That's why I'm still here. So let me go to a trade that I'm in. Let me remove something so that this thing will become okay. So let me go to Euro GBP. This is a trade that I'm in. Okay, so you can see that the red part we have 17 pips, meaning I'm risking 17 pips, and the green part we have 197 pips. Okay, so you can use the risk calculator too. So we have 197 pips. Okay, sorry guys. So this was what I was talking about. You can use the long and short position calculator here, okay, and you will know your stop loss. The red part is your stop loss, the blue part is your take profit. Okay, so you can set different take profits. You can set different with this trade like this. My first take profit is here. It's 120 pips at 0.83325. That's the price. So my first take profit is 120 pips. Okay, so we will come back here. Let's go on to our lesson. So you can use the TradingView pips calculator to calculate your pips. Okay, and this is the pip value in dollars. Okay, one pip on 0.01 lot size is $0.1. One pip on 0.10 lot size is $1. One pip on one lot size is $10. Okay, so let's go back to the TradingView. Supposing I'm using $100 account, which I'm supposed to use 0.01 lot size. Let me go here. 120 pips, I'll be getting $12. Okay, so the 120 pips I will be getting $12. And if I lose, that means the $17 I'll be losing just $1.7. I'll say just $1.7. So this is how to calculate the pips. So if it is 0.10 lot size, which are supposed to be used $1,000 account, the 120 pips will give me $120. Why? Because on 0.10, let me go here. On 0.10 lot size, one pip, one pip on 0.10 lot size is $1. So the 120 pips would have given me $120 if I'm using 0.10 lot size, and the loss would have taken my $17 away. The same thing, if I'm using one standard lot size, one pip is $10. Okay, so the 120 pip should have been giving me $1,002, and the 17 pips will have be $170 stop loss. Okay, and the take profits will be giving 1,002. Sorry guys, $1,002. Okay, so this is how to correspond your account size to the pip value, and then the value in US dollar. Okay, so now let's move on. Please, I suggest that you watch this video, especially this part, at least twice, because this thing is sometimes a bit confused if you are starting, or if you are a newbie, if you are a new trader. Okay, so now let's move on to the next thing. Let's move on to the next thing. Now, this is my personal risk management. I suggest you follow. It will help you. On $1,000 account, I rate $30 per trade. Okay, on $1,000 account, I risk $30 per trade. Because of my strategy, I know what I'm doing. So on $1,000 account, I risk $30 per trade. So let's get back to the trading view again. So let me see this 17 pips stop loss. Let me bring it here so that you guys can see. This 17 pip stop loss. I think people are still not seeing the 17 pips. So let me use the rare pip calculator so that the 17 will come. 17. So now we can see the 17 here. You can see the 17 here. This is the 17 I'm talking about. So with this 17 pips, if I'm using $1,000 account, I can use 0.10, 0.102. Why? Because if I lose on 0.10 lot size, I'm going to use $17. Okay, and my risk on each trade is $30. That means I can take two positions, $17 each. It will be, I think, $34. That is close to 30 pips. It's not bad. That's close to $30. It's not bad. So let's assume that the stop loss was, or the pips for the stop loss was 10 pips. With this one, I can use 0.30 lot size. Why? Because I'm rating $30 and my stop loss is $10. So I can use 3 times my stop loss because my risk is $30. Okay, so the higher the risk, the lower the loss size. Okay, and the lower the risk, the higher the loss size. That's why I'm urging you guys to watch the video at least 2 times, because these things, if you are new, you become confused. But this is the most important part, the risk management part. Okay, this is the most important part. Good. So now let's move on to the next thing. As I was saying, for $100, if the stop loss is below 10 pips, I use 0.03 and 0.30 for $1,000. Okay, and if the stop loss is 11 pips to 17 pips, I use, that is on $100, I use 0.02, and on $1,000 I use 0.30. Okay, if the stop loss is between 20 pips and then 30 pips, I use 0.10 on $100 and then 0.10 and 0.10 on $1,000. 0.01 on $100 and 0.10 on $1,000. So as I said, the higher the risk, the lower the lot size. The lower the risk, the higher the lot size. You get it? Good. Now let's go to trade management. Trade management. Now, break even. How to set a break even? Okay, how to set a break even? Let's go to the chart. You see that now my trade is running profit. Okay, so I can move my stop loss to my entry. Can shift my stop loss to my entry. With this case, when the trade reverses to the opposite direction that I intended, if the trade goes against me, it will come and then take me out either where I entered. not at the stop loss. So in this case, I lose nothing. Okay, so here you can see that, let me double click it, you see something. Let me go to inputs. You can see that my 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 stop loss price is here. My stop loss price is 0.84692. Okay, and my take profit level price is 0.83325. Okay, and my entry is 0.84529. That's my entry. Now, if I want to set a break even, I delete this price. Okay, I delete this price and then input the entry price here. You do this on the trading on the MetaTrader, because this is just the analysis. This is not where your money is. Your money is on the MetaTrader, not on TradingView. Okay, but you use TradingView to do analysis and then input the figures on the MetaTrader. So you delete your stop loss, which is 0. You delete it, which is 0.84 something something, and then you input your entry price. Okay, sometimes a little below the entry price and then a little below the entry price. Why? Because there is something we call spread. That's the money the brokers get. Okay, so when you do it exact the entry price, you are going to still be in small loss because of spread differentials. So sometimes you move it to somewhere here. So for sell trade or for short trade, for each break even is below the entry. Okay, for sell trade, if its break even is below the entry, so you can move your stop loss to somewhere 0. Let me show you the price, the red price here, 0.84485. Okay, that's break even. So for sell break even, your stop loss should be below entry. Take note, for sell position, when you want to set break even, your stop loss should be below your entry. Now for buy positions, when you want to set break even, your stop loss should be above the entry, something like this. This in fact, this is one of the trade I had this week. Okay, one of the trade, almost 340 pips within 8 hours, because for this 4-hour time frame. Let me bring the watermark so that you can see the time frame I'm in. 4-hour time frame. This 4-hour time frame, you can see the GBP in 4 hours. So one candlestick is 4 hours. So within 8 hours, I had over 340 pips. So for if I used 0.10 on $1,000 account, so I've gotten $340. $340 is not a small money. In Ghanaian cedis or in Nigerian naira, it's not a small money. Okay, so let's move on. For I know some of you know this, but for the sake of people who don't know, let me take my time to explain. So for buys break even, you want to set break even for buy or long position, your stop loss should be above the entry. Okay, but for sell, as we saw on Euro GBP, your stop loss should be below the entry. For the buy, your stop loss should be above the entry. So that is how to set break even. Okay, that is break even. I will prepare a video on MetaTrader for how to set up a break even for you, but this is general knowledge about break even. Okay, so now let's move on to our notebook. Now, partials. Remember, the market is not your friend. Keep this in mind. Keep this in mind that the market is not your friend. In fact, the market was designed to take your money. Let me tell you the truth. The market was not designed to give you money. The market was designed to take your money. Why? Because some years ago, some decades ago, the trade was only be doing by banks. It was bank who were trading those days. Okay, it was banks. Now, when they open the trade for individuals to trade, we become the retail traders. We are retail traders because our money doesn't reach the level of the the banks, the big institutions, the smart money people. Okay, smart money is the same as banks. I will come to it. So the markets, the smart money people, the banks who have a lot of money, they take our money to fulfill their order. When they want to buy, I said this in the liquidity video. Okay, if you haven't watched the liquidity video, when you watch it, you understand this properly. When they want to buy and there are not a lot of sellers in the market, they manipulate the market to persuade people that people are, I mean, people are coming. The market is going to go up, so they buy. When they buy, when the market started to go up, and then people see people buying, and the banks sees that the bank see that, oh, there are a lot of buyers in the market, then they sell. So the big institutions with the big volumes, they go opposite where we the retailers are going. So that is why this concept called smart money is very powerful. Why? Because this concept was derived from how the banks trade. Okay, the smart money is banks, other blocks. Other blocks are block means big money, block of money. That is the term, that is where we got the other blocks from. Okay, so other blocks means that big blocks, big position, and this big position, billions of dollars can be placed by only banks and hedge funds. Okay, so smart money concept was derived from how the banks trade. Now coming back to the partials. So whenever you are in profit, take some profit. Let me say your profit target is 150 pips and it has run about 70 pips. You can close half of your position and then we will hold the remaining ones. Okay, because the market can reverse and hit your break even or hit your stop loss without you knowing. So whenever you are in profit, take some profit and then hold the positions. Okay, hold the position. Good. So this is what trade management, risk management, and is all about. Okay, risk management is all about. As time goes on, I know you guys will understand it and understand it properly. Thank you very much, and then see you in the next video. Once again, my name is Kefusu, and I'm here to help you to become a professional forex trader. Bye bye.